Many farmers have elected to defer the yield portion of crop revenue insurance policies for the last few years. And now the question is arising on if the revenue portion can be deferred for tax purposes. Roger McEowen with the Washburn School of Law joins us now with a closer look. Roger, always good to visit with you. So what are some of the basic elements to keep in mind here?
Well, good to be with you, Tammy. Because the deferral provision only applies to insurance payments that are received on account of actual physical damage to crops, the deferral rule is really tricky when you try to apply this rule to crop insurance that pays out based on price or yield. It's not directly tied to damage to crops. Now, with revenue protection or yield protection or group risk policies, only the portion of that payment that's attributable to physical loss is deferrable. So once you know what your approved yield is and your base price and your harvest price and your insurance coverage your level and your revenue guarantee, then there's an approach. We use a formula for calculating the deferrable amount based on yield loss. But any amount based on the decline in price from planting to harvest would not be deferrable. So it's not as simple as many people think.
Right. And what if multiple crops are involved?
Well, this is another twist to this. In general, of course, we're going to include crop insurance proceeds in the year they're actually or constructively received. But if you're on the cash method, that's where you can use this technique to defer and continue your normal deferral practice. If you've been deferring crops and that's your normal business practice, you can defer the crop insurance. Now, if multiple crops are involved, that 50% test, and what I mean by that is in order to be eligible to defer, you have to carry more than 50% of your crop sales into the following year. Well, if I've got beans and I've got corn and I've got wheat, for example, I've got multiple crops involved, you have to meet that 50% test with respect to each crop if each crop is associated with a separate business.
Any more final advice for producers on this topic?
Well, as you can see, there's a lot of moving parts associated with this, so make sure you get good advice.
All right. You know what? Last week, we actually talked about the importance of estate planning, and trusts are a popular part of an estate plan for many people, and they can come in different forms, including an irrevocable trust. Any guidance for producers who might be looking to get out of an irrevocable trust?
Well, normally you can't. That's the nature of an irrevocable or irrevocable trust. But in 30 states, about 30 states, they've got statutes that allow trust modification, and other states will allow trust modification under common law. And some of the courts have determined that this should be allowed based on the notion that the trustee can distribute trust corpus, which means that the trustee has a special power of appointment to do this. Now, why you might want to do this is because later you found that there's a defect in the drafting of the trust, in the language of the trust, or there may be a state law provision that changes or a federal law provision that changes that now you need to conform to. But what this allows you to do is basically create a new trust and dump the current provisions into a new trust that's drafted properly to carry out your intentions. But as long as everybody's on board with that, you can do it.
All right. Very helpful. That's Roger McEowen with the Washburn School of Law. Appreciate your time today.